Roku stock investors have experienced a volatile year in 2024. The stock started off hot, rising from $90 to $100 a share, and then crashed all the way down closer to $50 per share in August. Since then, the stock has caught a tailwind and bounced back higher, up approaching over $83 a share. But news from the trade desk and a potential competitor option has investors worried still. All that being said, what's a fair price to pay for Roku stock? That's what I'm going to answer in this video, doing the discounted cash flow valuation analysis on Roku stock to determine how much I think a fair price is for each share of Roku stock. I'll show you where I'm getting all the numbers and estimates so you can decide if I'm using numbers that are too high or too low, or if my numbers are right on point. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so three of the numbers I'm going to need is Roku's market cap, which stands at $12.12 billion, its cash and equivalents balance at $2.127 billion, and the total long-term debt, which the company has zero long-term debt. I also need its shares outstanding, which are 144.86 million. The company's beta is 2.07. That's a relatively high beta, and I've done a couple scenarios that estimate Roku's price at a lower beta, so we can see what the valuation could be if the beta is lower. I also need Roku's Wall Street Analyst estimates for free cash flow over the next several years. And according to those analysts on Wall Street that are following Roku stock, they think it's going to deliver $230 million in free cash flow in 2024, $340 million in 2025, $510 million in 2026, and a jump to $800 million in 2027. So the analysts on Wall Street are expecting robust increases in free cash flow for Roku over the next several years. And this is fueled by increasing customer count and increasing engagement from existing customers. Roku is already the #1 TV operating system in the United States, Mexico, and Canada. So it's expanded outside the United States and proved that it's the best operating system. I've tried several TV operating systems, and Roku's is by far the best one that I've used, and it looks like many consumers feel the same. Now, the Trade Desk, which is a competitor, has announced that it's launching something similar to what Roku has, a TV operating system, in 2025. So that's going to be interesting to see how that impacts Roku's market share in this industry. That remains to be seen. So now that we have all the estimates and the inputs that we need, we can jump into the valuation model for Roku stock. Starting with this free cash flow estimate for 2024 at $170 million, rising to all the way up to $800 million in 2028. These estimates over these next 5 years between 24 and 28 are from Wall Street analysts that are following Roku stock. I just pulled those numbers directly from the Wall Street analyst estimates. I made zero adjustments on those numbers. So if the company indeed grows its free cash flow between 24 and 28 at these levels projected, that would mean that it increased its free cash flows at a compound annual growth rate of 46.5% in that time. So from that point onward, I'm going to use my own estimates for free cash flow. And between 2029 and 2034, I'm forecasting that Roku will grow its free cash flow at half the rate of these next 5 years. So instead of 46.5%, I'm going to have the growth rate slowing down to half that rate, 23.25%. And then from 2035 onward, I'm going to estimate its free cash flow grows at 5% to perpetuity. And the reason I choose 5% is because that's where I feel nominal GDP will be in the countries that Roku operates between 2035 to infinity. So those are the free cash flows estimated all the way out to 2035 and how I derived those free cash flows. Now, because these are free cash flows estimated in the future, we need to discount them back to today because money in the future is worth less than money today. And there's a technique where we can take all of those free cash flows that are expected in the future and evaluate them all at how much they would be worth today. And that's called the discounted cash flow valuation. So that's what we do here. So we take a discount rate, which in Roku's case, I'm using a weighted average cost of capital of 16.16, right? 16.16%. And the way I arrive at that is by using a capital asset pricing model of 16.62, applying a beta of 2.07 with a risk-free rate of 4.2% and a market risk premium of 6%. Now, the company has no debt. Its market cap is 12.2 billion, but when you're applying a weighted average cost of capital, you've got to look at the target capital structure for a company, not just the existing capital structure. And I'm going to assume that the company does want to take out some debt at some point in its future. And I'm going to use a conservative estimate here and just assume that it will have a target capital structure of 5% debt and 95% equity. Although I do think in the longer term between, let's say, by 2035, I think the company will have a lot more debt than it does now. And the reason is, if you can look at this capital structure I've highlighted, if you look at the cost of equity here, I have their cost of equity at 16.62%, whereas the cost of debt is only 7.5%. And that's usually the case for every company, is their cost of equity is higher than their cost of debt. Companies can borrow money at a lower price than companies can get money from investors through an equity investment. And that's understandable because when you're investing in a company's bonds, the cash flows are almost, well, the promise of the cash flows are guaranteed. So as long as the company doesn't default or enter into any financial distress, bond investors know precisely how much they're going to receive. And so because that is more certain, they're willing to accept the lower rate of return to invest in bonds instead of investing in stocks where the returns are uncertain. So if we take all of those present values of the cash flows, and I shared with you what discount rate I'm using, we get a value of operations of $10.37 billion for Roku. To that total, we need to add the company's cash, which brings us to a value of equity of $12.5 billion. Then we take the number of shares and we divide that with the value of equity to give us a price per share, which brings me to the intrinsic value of Roku stock of $86.26 compared to the current market price of $83.44. So my intrinsic value suggests that Roku shares are fairly valued, not over or undervalued. But remember, I said the beta is relatively high at 2.07, and in the long run, companies typically gravitate towards a beta of 1. That's the average risk of a stock in the S&P 500. That's where companies gravitate towards. Their beta gravitates towards 1. As they grow larger, as they become less risky, they gravitate towards a beta of 1. So if we are to assume Roku's beta falls to 1.5, its price per share could be worth $128. So there is some upside here to Roku shares if you assume that the beta will fall over the next several years, which I'm not assuming in my base case. I'm just leaving the intrinsic value at $86. But I did some scenario analysis to show me that there is upside if the beta were to decrease either to 1.5, and that would mean $128 share price, or 1.25, and that would mean $160 share price. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.